In this video, we will see how to determine the discount rate. Then we will look to practical cases in Excel where you can calculate the weighted average cost of capital together for Duolingo, which is leading mobile language learning application. Let's dive in. Now we are going to talk about one of the most important concepts in financial valuation, the weighted average cost of capital, and it presents our return acquired by a company investor, both equity holders and debt holders. It's commonly used as the discount rate in financial valuation. In DCF analysis, we use WACC, discount future cash flow, to present value. The required return on both equity and debt holders. Higher risk mean a higher WACC, which lower the valuation of the future cash flows. Let's break WACC down into its key components. WACC is made up of three main components. Cost of equity. This is the return that shareholders expect for investing in the company. It's calculated using the capital asset pricing model, CAPM. Second, cost of debt, interest rate that company pays on its borrowed fund. This is the interest rate that the company pays when borrow money from this institution. It's adjusted for tax because interest expenses are tax deductible. And capital structure, which is debt versus equity, because companies finance their operation throughout a mix of equity, selling stock, and debt, which is the loan or bond. So when calculating the WACC, we consider proportion of each one of them. First, let's start with the cost of equity. The cost of equity is calculated using the capital asset pricing model, which is risk minus free rate, which is risk-free rate plus beta multiply times market risk premium. Risk-free rate usually the yield on 10 years US Treasury bond, and beta measure how volatile the stock is compared to the overall market. Example, the beta for Apple is 1.3, indicating higher market volatility and market risk of premium. This is the extra return investors demand above the risk-free rate. Example for S&P 500 premium of 5.5 over risk-free rate. This is how the investor demand above the risk-free rate. Now let's move to cost of debt. Is simply the cost of debt. RD is simply the interest rate a company pays on its borrowed fund. Since the interest expenses are tax deductible, we adjust for tax. Formula for cost of debt are after tax cost of debt equal to interest rate multiplied times 1 minus tax. The interest, this is the rate which the company can borrow fund. Tax shield, this is the interest paid are tax deductible, reducing the effective cost of debt by allowing company to offset taxable income. Then we have the rating influences the interest rates a company. This is the capital structure for the company. We have equity. This is the market value of the company stock. Then we have debt. This is market value of the company borrowed fund, and we get the ratio for. Once we have the cost of equity and the cost of debt, we calculate the WACC. We have an example here for company XYZ financials. First, let's start by looking to the formula for the WACC. We have E stand for equity divided by the equity plus debt. So here, in order to get the proportion for equity compared to the total equity and total debt cost, plus debt divided by total equity plus total debt, multiply by the after-tax cost of debt times 1 minus the tax rate. In this example, we have total equity of 600,000, total debt of 400,000, cost of equity is 12%, cost of debt 6%, tax rate 25%. So here the calculation, we get 60%, which is the total equity, 600,000, divided by the total equity plus total debt. We get total of 1 million. So 600 divided by 1 million, we get 60%, multiplying by the cost of equity, 12%, plus 40%, which is the proportion for the debt, multiplying by the 6%, which is the cost of debt, times 1 minus 25% as tax rate. And we get the WACC for 9%. This means investors expect 9% of return on their investment on company XYZ. Now, where do we find the input to calculate WACC? Risk-free rate, can get it from US Treasury, and we get it from Federal Reserve website. Typically, we use 10 years Treasury bond. For beta, we get it from Yahoo Finance, Bloomberg, and Reuters. And the risk and market risk premium, we get it from historical data. We can get also estimated from the modern database, which is widely used source for market risk premium, and typically is between 4-8%. Then for the cost of debts, we check it from the financial statement of the company, which we can find it for the interest expenses and debt. For credit rating, we use there are some agencies like Moody's and S&P influence borrowing cost. Now let's calculate the weighted average cost of capital. This is the formula. We put it here to make it easier for us to track our calculation. So the formula will be the E, which is equity, divided on the total of E plus D, which is equity plus debt, multiplied by the cost of equity. We call it E, cost of equity, plus D divided by the addition of equity plus debt, times the cost of debt, times 1 minus tax. We have a link here for website that will be used in valuation. We get the valuation facility available. They use some information. This is for this valueinvesting.io. We have valuation for our company. We have some information. They choose the WACC or discount rate for 8.5. I don't know how they calculate it, but we will calculate all together. And they said the range is between 7.5 and 9.5%. Long-term 3%, 4 to 5%. They took 4%. This is all the detail. Yeah. You can make search for any. So far it's free. Let's back to our Excel. So this is the formula. So I already created this information, put them all together, make it easier for us to track it. So the first thing that we need here is the risk-free rate. This number, we get it from usually the yield on 10 years usually Treasury bond. We can find it in the US Treasury curve or we can find it in Yahoo Finance. Usually it's 4.5%. Now we need the market return rate. This is the expected return of the overall stock market, example S&P 500, where we can find this information. We got 8%. Now we need beta. This is measure stock volatility compared to the market. Check in Yahoo Finance. For beta, we get information from the Yahoo Finance. We go to Yahoo and the statistic, and we check, and you see that beta for 5 years is 0.79. This number means that the stock is 20% less volatile than the market, since it's less than 1. This means Duolingo is less risky than the overall market, but investor may accept lower return. Back to the calculation, we need to calculate the cost of equity, which will be part of our WACC calculation. This is the formula: cost of equity equal to the risk plus beta times the risk market return minus the risk-free. So I will repeat, the formula for cost of calculation is the risk-free plus beta times the market return minus the risk-free. Let's do the formula together. So we said that the risk-free is 5% plus beta, which is 0.79 times the market return, which is 8%, minus the risk-free, which is 4.5%. And we get the cost of equity of 7.3%. So here the cost of equity is lower than 8% because our beta is less than 1%. So we finish with the cost of equity. That means we have the first formula. We got the cost of equity. Next, we need to calculate the total capital, which is D plus E. For the total debt, we get it from the financial statement. So we go to the financial statement. We search for debt. This is the data that we get from Yahoo Finance. And we need to get the debt for the last year, which is 22 million. Then we need to get the total equity for the company. We go to our statement. We search for the equity and we get the value of 850. Then we have the total debt plus total equity of 872. So we need these three items to calculate our weighted cost of capital, because here we need E is available. We need E plus D. Got it. And for the second part, for the formula related to the debt, we get the total debt. We get the total debt plus. We have some information. It can be not necessary here, but it's helpful. So here the debt weight compared to the total of capital, and divide 22 million total debt compared on total equity plus debt, and we get 2%, 2.5%. Then we have equity divided on total, and we get the percentage of 97.5. That means the external money expended in its business is coming from equity, from shareholders, and it's rely only 2.5% on the debts. That means from borrowing money from the bank. Next, we need the cost of debt. So we go to the financial statement. We check if the company is paying any expenses cost. When we check, we see there's interest income losses. We go also to the income statement, which is more detailed. Check line by line. Haven't found any interest costs. That means the company has no cost of debt. So we go back to our WACC and we put 0. Next, for the tax rate, we use 20%. We don't have real information about the tax. Can get it from company website or from the income statement. Here we put 20%. We calculate the weighted cost of capital. The formula will be as follows. First, we need the E, which is equity, divided on the total of equity and debt. Times the cost of equity, we already calculated, which is 7.3%, plus the second part for the formula, which will be the debt divided on the total of equity plus debt, which is this line. This is times the cost of debt. We said it's 0%, times 1 minus the tax rate, and we get weighted average cost of capital of 7.1%. So for the tax, even if we put 10%, there is no big impact on the WACC calculation. For that reason, I used 20%, which is the average in USA. But if we change beta, everything will change. 1%, and it's our WACC will change. So this is the calculation for WACC. We have a WACC of 7.1%, and this is under our